Chapter 14, last part, Financial Statement Analysis, Part 4. In this section, we look at the concept of earning power. We also look at irregular items and how we present them on the income statement. And we also talk about quality of earnings. So when we look at earning power, we're really asking, what are the future cash flows of a company? And what is the sustainability of its current cash flows into the future? And so the value of a company is a function of this. And so if you have a really great year, we're going to ask, is this sustainable or not? Or is this an exceptional year? And should we expect that same income flow, that same sales flow in future years? Now this is affected by a lot of things: accounting methods and estimates. And of course, that's dependent on what your industry practices are. And as we've seen since the Enron scandals and the WorldCom scandals, there is a requirement for full disclosure and consistency. And so, by the way, as an aside, notes to financial statements, that big section at the back of the financial statements has just grown bigger and bigger since Enron, as companies have rushed to make sure they fully disclose everything that they're legally required to do. We're going to look at something called non-operating items on the income statement, and I've abbreviated those as DEA. The DEA, 3 types of irregular items: discontinued operations, extraordinary items, and changes in accounting principles. DEA, not Drug Enforcement Administration, but that's a good way to get that order right and maybe remember the numbers, the names of those. Discontinued operations refers to disposing a segment of your business, and this is particularly relevant for these conglomerates that we talk about, these big diversified companies like Kraft Foods, which actually consists of many, many different segments, including cigarettes. So companies have to report discontinued operations separately if it's significant, and significant is defined as 10% or more of your business. So an example of this is the Pepsi company used to own Taco Bell, Pizza Hut, and Kentucky Fried Chicken. They spun them off, they divested them, spun them off as a separate company. Quaker Oats used to own Gatorade, and they spun that off. And when we use the term spun off, we're saying they divested. In Pepsi's case, they formed a new company. In Quaker Oats' case, they sold Gatorade to another company. I think it was Pepsi, as a matter of fact. Western Wireless used to be one big company, and they created 2 companies out of them, VoiceStream and Western Wireless. And if you know your local Bellevue history, you know that VoiceStream became T-Mobile, and Western Wireless became Alltel. And finally, PACCAR, Bellevue also, used to own 2 divisions called PACCAR Automotive and Trico. PACCAR Automotive was the parent company of Al's Auto Supply and Grand Auto in California, and they sold those companies. And Trico was based in Texas and Oklahoma, and they were oil well digging manufacturing company, and they sold those. So let's say you're a company. Let's take an example here, AgroWorld. During 2001, the company discontinued and sold its chemical division. Now, I grew up in a farming community, and chemicals are a big part, unfortunately, of agriculture. And the popularity of the organic movement has caused a lot of companies to rethink the use of chemicals. And so it looks like, without knowing anything more in this situation, it looks like AgroWorld has made that decision. So they take the chemical division as if it were a separate income statement, and they have to do something. At the moment they announce that they're going to discontinue it and sell it, they have to create an individual income statement just for the chemical division. And as of that date of the announcement, and they come down and they have net income from chemical operations of $200,000. From the announcement date to the date they finish disposing it, maybe it's 2 or 3 months later, all of those costs, netted against any revenue that they bring in for selling the company. In this example, yielded a loss on disposal of $130,000. And this is not untypical. Let's say you sell all the assets in a company. You tend to sell them below cost, and so it's very common to have a loss on disposal. You can also have a gain on disposal too. Now, this company, AgroWorld, is overall a profitable company, and they overall pay a 30% tax rate. We report these and we include the tax rate in this discontinued operations. Another way to word this would be to say the income from operations in the last slide was $200,000, but net of taxes, we'd take 30% of $200,000. Net of $60,000 in taxes, that actual income is $140,000 after taxes. The loss on disposal was $130,000, again times the 30% tax rate, is only a loss of $91,000. Now you don't pay taxes on losses, but what this loss, the $130,000 loss, actually serves as a deduction for the overall AgroWorld. And so it has the effect of saving them $39,000 in taxes because they were allowed to deduct the $130,000. And that's a little complicated, the tax piece of this. But what we're trying to do is take all the discontinued operations out of the normal income statement. So this AgroWorld is a partial income statement. I've stopped here, income before income tax. There's a lot more on top of this that would take another page to report. There's sales, there's cost of goods sold, there's general and administrative costs, operating expenses, and all of those come down to this number, $800,000. Then we're going to apply the income tax rate, and we have a new subtotal here called income from continuing operations, and that is really your gold standard for AgroWorld. What that is it's saying this is the income that we would go forward with. These discontinued operations, they actually contribute to our bottom line, but next year we won't have the chemical division anymore, so it's not sustainable. So as we look at earning power, we really focus on continuing operations. So this 30% tax rate is only applied to the business that's going forward. Down here, discontinued operations, we always show two separate lines, income from operations as of the announcement date, and then the subsequent loss from disposal. So we have the $140,000 net on the income and the negative $91,000 loss net after we've deducted taxes. So these taxes up here only apply to continuing operations. Okay, so that's discontinued. We now have a new subtotal because for AgroWorld we're going to show all three irregular items: discontinued, extraordinary, and accounting changes. So our next subtotal is net income before extraordinary. What is extraordinary? In order to qualify as an irregular extraordinary item, events have to be unusual in nature and infrequent in occurrence. For example, a volcano going off. If Mount Rainier in Seattle, or in the Washington State, not in Seattle, were to explode, that would be unusual and that would be infrequent. However, if a volcano in Hawaii exploded, that would not be unusual and it would not be infrequent. So what does that mean? That means they would have to report that loss, extraordinary item, it would be a loss in that case to volcano damage, as part of their continuing operations. Extraordinary items are usually effects of major casualties, for example, what they call an act of God, an expropriation, where a government takes over property. This happened in China during the Cultural Revolution. Some of the oil companies were taken over by China, and the oil companies lost that money. Effects of newly enacted laws or regulations, such as a condemnation action. So if they come along and condemn your building or require you to upgrade something, that's an extraordinary item that you weren't planning on. What are ordinary items? Ordinary items are major casualties that are frequent in the area. If you grow oranges, I grew up in orange country in California, and if there was a freeze one year, well, that really wasn't extraordinary. Freezes do happen, and you can lose some of your oranges due to freezes, to cold weather. Writing down inventories or writing off receivables is something we do in the normal course of business. We don't like it, but it is something we expect, and it does happen. Losses attributable to labor strikes, again, something that happens occasionally as a result of collective bargaining. And then gains or losses from sales of property, plant, and equipment. All of these items would be above the line as an other expense as part of continuing operations. They would not be reported as an extraordinary item. So let's take Agro World. They had some property, maybe a manufacturing plant or something in a foreign country, and the revolutionary government expropriated the property. They lost everything. This loss is $80,000 before applicable income taxes of $24,000. We're still using that 30% tax rate as an example. And the income statement presentation will show this as a deduction of $56,000. And you see it here. Expropriation, again, when we have a loss, it's net of the tax savings. So $56,000 is subtracted and we bring it down. Now we have net income of $553,000. Let me back up there a minute. The sustainable continuing operations is $560. Income before extraordinary is $609, and net income is $553. Net income is what all those calculations that we looked at in ratio analysis are calculated on. But the company's going to really focus on $560,000 in its press releases and its announcements. And honestly, the external analysts do too, because they know that this is what's sustainable. Whereas these irregular items are a one-time deal. But the important thing is when you look at the income statement, you can ask the questions. You can't answer them, but you can ask the questions. Thanks.